Everyone argues about term life, whole life, and IUL, but the truth is most people don't actually understand how any of them work, and because of that, they either pick the wrong one or they avoid making a decision at all. So in this video, I'm going to break this down as simply as possible so you actually understand what you're looking at and, more importantly, which one might make sense for you. Let's start with term life insurance. Term is the simplest form of life insurance. You're paying for coverage for a set period of time, usually 10, 20, or 30 years. If you pass away during that time, your family gets paid. If you don't, the policy expires. That's it. No savings, no cash value, just pure protection. That's why it's the cheapest option, and for a lot of people, that makes sense. If your goal is to protect your income while your kids are growing up or cover your mortgage, term can definitely do that very efficiently. But here's the problem. No one talks about what happens at the end, because at the end of that term, one of two things happen. Either your coverage disappears completely, or you try to renew it. And now it's significantly more expensive. I've seen people go from paying $40 to $50 a month to $300, $400, even $500 per month. Why? Because now they're older and their health isn't perfect anymore. So now you still need coverage, but it's either unaffordable or unavailable. That's the risk. Now, let's talk about whole life. Whole life is permanent. That means it lasts your entire life, as long as you keep paying into it. It also builds cash value, so part of what you pay goes into a bucket that grows over time, and you can access that money later if needed. Whole life is more stable, more predictable, more guaranteed, but it also more expensive. So the trade-off is simple: more cost, more certainty, long-term protection. Now, let's talk about IUL, Index Universal Life. This is where things get interesting and also where people get confused. IUL is also permanent coverage, but instead of growing at a fixed rate, your cash value is tied to a market index like the S&P 500. Now, you're not directly invested in the market, but your growth is based on how the market performs with certain limits. So you get upside potential, downside protection, and flexibility. But this is important. It has to be structured correctly, because if it's not, it can underperform or create problems later. So here's how I want you to think about all three. If your goal is simple, low cost protection for a specific period of time, term makes sense. If your goal is long-term, guaranteed protection with stability, whole life might make sense. If your goal is flexibility, growth potential, and long-term strategy, the IUL might make sense. But here's the key point: there is no best option. There's only what fits your situation, your income, your goals, your family, your timeline. All of that matters. If you're trying to figure out what actually makes sense for you, I'll help you map it out. Click the link in the description and go through the financial protection checkup. And if you want to avoid making the biggest mistakes people make with life insurance, make sure you check out this video. Next, I break down the 7 mistakes I see all the time.